All right, so in talking about the tools the government has to affect the economy, there are two primary ways. One through fiscal policy and the other through monetary policy. Both of these have two different sets of tools, and the principle that underlies these policies is the same. And if you can remember this, then you can take the tools and figure out how to use them. But the principle is, if you put money in the pockets of people, they will spend it. Spending speeds up the economy. Not spending slows down the economy. So if you can remember that principle, people will spend money. If they have it, they spend it. If they don't, they won't. Then you can figure out how these tools work. So here we have a graph of an overall economy. And the dotted lines here represent economic equilibrium, which is where we want to be. That's a place for a good, healthy economy. So anything outside of these lines, like right here, is bad. That's too fast, leading to inflation. And anything below the lines here is too slow, leading to a recession. And the problem with an inflation is that we see prices increase, which reduces the purchase power for the consumer. You can actually buy less with the same amount of money. And in a recession, when it gets too slow, what we see is unemployment increases and people lose income because of unemployment and spend less. So both of these are self-perpetuating cycles. So what can the government do about this to keep a good, healthy economy? Well, with fiscal policy tools, they can, number one, use taxes. So if they lower taxes, indicated here, then consumers will spend more because they're not paying as much to the government. They'll have more money in their pocket and they'll spend it. If they want consumers to spend less, maybe the economy is going too fast, then they'll increase taxes, which will put less money in the pockets. If they don't have the money, they can't spend it. The second tool they have is government spending. Now, this takes form in a couple different ways. The best example is the American Recovery and Reinvestment Act from 2009 under President Obama, where he planned for $787 billion, federal government dollars, to be spent to help education, to help rebuild bridges and roads, and to put America back to work. So by increasing that government spending, unemployment lowers. People work, they get money, and they spend it. And that helps to raise the economy, speed up the economy. On the other hand, if the economy is going too fast, they can cut back on that spending, which again will take money away from people. It takes it out of their pocket, and it slows down the economy. On the monetary side, we also have two tools. We have interest rates. So currently, the Fed interest rate is 1.75%. If people go to borrow money from banks or they want to buy a home, the mortgage company that they want to borrow money from is going to charge them an interest rate. The lower the interest rate, the more money and more likely people are to borrow money, but the more money they'll borrow. If they have the money, they spend it. It's the same principle. So if the interest rates go up, then people borrow less and spend less. If the interest rates, also known as the discount rate, go down, people will borrow more and spend more. Okay, so that's a third tool to control the economy. And finally is controlling currency. Now, this is done through banks, and banks are private institutions. And the only way that the government can really control the banks is through what's called the reserve amount, the reserve requirement here. And what this does is it requires banks to keep a certain percentage of money in their bank given how much they've loaned out. So let's say that they've loaned out $1 million and the reserve requirement is 10%. Then they're going to have to keep $100,000 in the bank and they cannot loan that out. Okay, it's kind of a measurement against liability in case something happens. So if the reserve amount goes up, then the banks will loan less money because that means they have to keep more money in hand. So people will get less money, meaning they spend less. If the reserve amount goes down, then the bank can loan out more of their money instead of keeping it, which means people will spend the money. So these are the two basic types of policy, and there's 4 total tools that can be used to influence this economy.